So yeah, as promised, we are going to work out with our first accounting rocket. This is basically a beginner level where you will have to understand and grasp the concepts that I'm going to teach you. So I'm going to give you a proper overview of the subject, and then I'm going to take you through the examples through it. So these are certain accounting concepts that you end up making mistake into your FYJC or SYJC level, Maharashtra board. I'm from Mumbai. I'm Pooja Chatwani, and I'm here to help you out on that. So stay tuned. Okay, so today our day's target is to understand what is the difference between goods and assets. We need to be very clear about what exactly are goods and what are the assets, because the treatment for both of them is pretty different. You will have to understand the basic concept that goods and assets, although it's a very small topic, but you need to have the basic understanding that goods are nothing but, for an instance, let's just take this air conditioner. This air conditioner is an LG air conditioner, and this air conditioner for LG company is good. However, this air conditioner for you is an asset. This person standing here is you. So for you, this is an asset, but this air conditioner for LG is goods. How do I differentiate both of them? For LG, this air conditioner is not just the only air conditioner they have. They're going to purchase a lot many, or probably assemble or make them, produce it, and then sell it further. It is used for further resale. The table next to the image is going to be very helpful for you. So goods are basically used for further resale. However, your assets are going to be used for your production or for your services as required. So in case I am a classes called as PMGT, Preeti Group Tuition. Our classes makes sure that all our students get air conditioned classes. For this, we need air conditioners, and these air conditioners for us are an asset, because I don't change it when student tells me, "अरे miss, पसंद नहीं आया, LG का है, हमें दूसरे कंपनी का और जनरल का चाहिए." I can't do that for you. It's my asset which goes on till the time either it breaks down, falls apart, or I have to buy a new one or something like that. Till that time, that is my asset. But the same air conditioner for LG is goods. So basically, any person who is the owner used a particular product for further resale is called as goods. However, the same product used by the owner for further production or for a reason of giving services is called as an asset. I hope that basic differentiation is pretty much clear. Now, the main bifurcation that comes here is goods are termed as purchase and sales. So, for me, this air conditioner is an asset. So, I cannot say that I have the air conditioner that I have purchased is my purchases. However, LG TV, LG Electronics would surely say that this air conditioner that I have purchased is basically my raw material, which I'm going to further sell. So for them, this air conditioner would be sales or purchases. So goods can be renamed as purchases and sales. However, your asset cannot be renamed as purchases and sales. Your assets will go to balance sheet. However, your goods will go to your trading account. I hope that differentiation is clear. I have discussed all this in the lectures. I'm just giving you a brief point of view before I go for the rockets. Okay. Second thing, when you are selling or purchasing goods, these cannot be adjusted into this. This does not need an extra profit and loss entry. However, your assets are going to need an extra entry for profit and loss. Goods automatically adjust the profit and loss in the account. However, assets do not have that capability of doing it, and that is why they have to be given an extra entry of profit and loss, which will be obviously routed through profit and loss account. I hope this concept is clear. I have taken things from the scratch for you to understand. So let's just go through a couple of examples. So basically, let's go through the rocket that I had shared with you. So basically, the course objective for this rocket is to understand the difference between goods and assets that I just discussed with you. The second one is the treatment of sale of goods and assets. And the third one is treatment of profit and loss of the goods and assets. So all these needs to be understood by you really well. I've given a few examples for clearing out your issues that you might be having in the given topic. I believe this set of question is already there with you. I don't have to discuss this further. You guys already have a set of questions. Great. So I'm just directly going to the answers, which I will be discussing. I hope my screen is pretty much clear. Okay, my first transaction was commenced business with cash of rupees 50,000. So here you need to understand only the owner of the business can commence the business. Commence bole to can start business. Owner of the business and cash are two important accounts that needs to be taken into consideration. Now here, your owner is going to be, your owner has one special account called a capital account. There will be no other account affected if it's the owner account. The owner's capital account is the only account that gets affected for any transactions related to the owner. Okay, now coming to the first one, commence business with the cash. So we have two aspects, owner and cash. We understand owner being flesh and blood. We call him what? Personal account. But cash we call what? As real account. Our owner and cash are classified into two different accounts, real account and personal account. So let's apply the rule of real account on cash. We are the business. Owner is giving us the money. If the owner is giving us the money for business, the money is coming in. Debit what comes in. And that is why cash gets debited. Who is the giver of this cash? Owner is the giver of the cash, and that is why we credit owner. Debit the receiver, credit the giver. I hope the first one was easy to understand and grasp. Great. Let's go for the second one. Purchased machinery on credit from Ahuja. You have a beneficial point wherein they have given you the words on credit. Even if they had not used the words on credit, and they would have given us a statement like purchased machinery from Ahuja, it was deemed assumed that it is on credit basis because nothing else is specified in the question. So credit basis is what? We do not pay them on the spot through cash, check, debit card, credit card, net banking, any modes. We do not pay them. We tell them we'll be paying them at a later stage. So basically what we are doing is doing it on a credit basis. Great. So in this case, the two main accounts that are coming into the picture is one is machinery account and the second is Ahuja account. Now in this case, machinery account is your real account and your Anuja account is going to be your personal account. For real account, the rule applies, debit what comes in. So for business, the machinery is coming in, debit what comes in. Debit the receiver, credit the giver. The giver of this machinery is no other than Anuja, and that is why Anuja account is credited. So debit what comes in, our goods, I'm extremely sorry, our machinery is coming in, and credit what goes out. So that it does not apply here. Debit the receiver, credit the giver. So the giver is Anuja. I hope the second one was also easy. We realize that machinery is not goods, it's an asset for us. So we do not replace it with the words called as what? Purchases or sales. Now, coming to the third one, a very important one, purchased goods. They're being specific purchased goods. If I'm talking about purchased goods, these goods are what? They are our recurring item. We are going to purchase it from somewhere and going to resell it. It is our business to do this. So these goods can be classified as purchases or sales. So here, purchased goods from Raju on cash. Here the words are very clear that it is on cash. If the words on cash were not returned, we would have considered this transaction as what? Which transaction? Credit transaction. So the two important aspects of this transaction is goods and Raju. Goods is your real account. Raju is your personal account because of course blood flesh comes into the context. Goods, debit what comes in. Business has bought goods. So for business, the goods are coming in. You and your business are two different people. It is business entity concept. Okay. For you, the business is coming in. Uh, sorry. The business, for business, goods are coming in, debit what comes in. So goods are coming in, we'll debit goods account. Debit what comes in, credit what goes out. Cash is going out. Cash is going out. So we have two aspects, good cash. Both of them are real account. Debit what comes in, goods are coming, credit what goes out, cash are going out. But we call it the different name. Goods are also called as what? Purchases. Great. Now, this can even be understood in a different fashion where we say purchases is our expense. So purchases becomes a nominal account, debit all expenses and bills. I hope that is understood really well. Okay, the next one that we have here is sold goods to Anisha on credit. Sold goods, making it very clear, goods are sold and not asset. So we can call it what? Sales. On credit, so we'll have to remember the person. We do not have any cash transaction or a credit transaction. Debit what comes in, credit what goes out, goods are going out. Debit the receiver, who is the receiver of the goods? Anisha. We have two accounts, Anisha and goods. We have grown up, we do not call it goods, we call it sales account. However, you can even understand this another way wherein we call it that this is sales. As in, it is a normal account wherein we consider it as an income. There are two ways of understanding it. Broadly, it is always looked to it as a nominal account, as the classification. But for better understanding, you have to understand these purchases and sales are of goods. And that is why I have taken this way out. However, the classification of purchases and sales still remain that of nominal account. Great. Now, let's go to our fifth transaction. Purchased plant costing 75,000 for cash from Meena, making it very clear it is nothing but a plant, an asset. Great. And for cash, because the words are very clear. So we have two aspects, plant and cash, both of them being real account. Debit what comes in, credit what goes out, plant is coming in, cash is going out. I think this was the easiest of all. Great. Come to sixth. Paid to Anuja for machine fees 15,000. If we go to our Anuja question, question number 2, we had purchased machinery from Anuja. We had purchased it from Anuja for 20,000. We were pending to pay Anuja 20,000. From that, we paid them 15,000. For us, the basic understanding is that 5,000 is still payable. But we have already credited Anuja by 20. We have already shown that it is payable to her to by 20. So all we have to do is we have to debit Anuja by 15, saying that 5,000 is still payable. And if you don't understand anything, the entry is very simple where it says we as a business paid money to Anuja for machinery. So for us, Anuja is the receiver and cash is going out. Debit the receiver, debit what comes in, credit what goes out. So Anuja is your personal account and your cash is your real account. Debit the receiver, Anuja account is debited. Debit what comes in, credit what goes out, your cash is going out, and the entry comes out to be Anuja to cash. I hope this is clear. This was a very important concept we understood. Okay. The next one that we have after this is the seventh one. Sold old tables for 3,000 costing rupees 5,000. Sold old tables. Now, in this case, tables is your asset. We are selling off our tables which of 3,000 at 5,000. For asset, profit and loss is recorded. I hope you remember this page really well. For assets, profit and loss will have to be recorded in the journal entry. So the tables are sold. The aspects are very clear. Debit what comes in, cash is coming in. Credit what goes out, tables are going out. The tables which are going out were costing rupees 5,000. But the cash which is coming in is costing only 3,000. There is a gap of 2,000. Your journal entry needs to be tallied. And that is why there will be dual effect in the debit side, saying that debit what comes in, cash of rupees 3,000 is coming. and there is a loss on sale of table of rupees 2000 to table account rupees 5000. 5000 minus 2000 is the loss. Basically 5000 का औकात था, 5000 के औकात का टेबल 3000 में बेचा, कम में बेचा, तो अपना क्या हुआ, लॉस हुआ. I hope this is clear. Next, 8. Started business with furniture rupees 1,50,000. This entry is just to make you understand that apart from cash, the owner can bring a lot other things into the business. One of them, furniture. So if the business is getting furniture, debit what comes in, furniture account debited, and debit the receiver, credit the giver, owner is the giver, and so the capital account is credited. I hope that is clear. This is as simple as the first journal entry, not much to understand. Great. Now come to the 9th entry, which is very important for you. Sold goods. Mark my words, the words are goods. The words are not talking about an asset. Sold goods to Charanjit, rupees 1600, which purchased from Raju, costing rupees 1000. Goods of some costing were sold at some price. Do we need to record the profit and loss entry? No. Why? Because these are goods. On this part, if instead of goods, it was an asset, we would have to record it. But it is not, so we don't have to record it. The words are sold goods to Charanjit, rupees 600. That is what matters for us. The entry ahead of that is really of no relevance at this point. So for us, this is a sales entry wherein there are two aspects. One is goods, one is Charanjit. Charanjit is the receiver of the goods. Goods are going out of the business because it's a sale. So two accounts, Charanjit and goods. Charanjit is personal account, goods is your real account. Debit the receiver because Charanjit is the receiver of goods. Credit what goods are going out. You can even interpret saying that sales is nothing but a nominal account, debit all expenses and losses, credit all income and gain. I hope this is clear. The classification between 7th and 9th is very important to understand. Great. The last one for the day, 10. Sold plant purchased from Nina for rupees 1 lakh to Dambu. We sold a plant which we have purchased from Nina for rupees 1 lakh to Dambu. Let's go ahead and check. 5th entry, purchased plant costing rupees 75,000 from Nina. We had purchased a plant which we are selling. Plant was costing 75. We sold it for 1 lakh. It's a profit. 75,000 का औकात 1 लाख में बिका, 25,000 का profit. Okay. So because it's an asset, we will have to record it. If it was goods here, we did not have to record it. For us, there are two important things. Sold to Damru for rupees 1 lakh. Sold to Damru. So here there is no cash transaction. It's a credit base. So we'll have to remember Damru and, yes, you're correct. We'll have to remember Damru and plant. Debit what comes in, credit what goes out. Plant is going up. Debit the receiver. Damru is the receiver of the plant. And profit on sale of plant, which we discussed, about 25,000. So 3 accounts which are affected: Damru account, plant account, and sale of plant account. Personal account for Damru, plant being real account. Profit on sale of plant is nominal account. So basically the entry would form as the Damru account debit because he is the receiver. Damru account debit for rupees 1 lakh. To plant account 75,000. Because the plant is going out, which costed 75,000, we cannot write more than what it costs. The more that we are getting after selling the plant is profit. So we'll have to name it as debit all expenses and losses, credit all income and gain, and that is why that gain or the profit on sale of plant is credited. Profit on sale of plant. I hope the lecture was fruitful, guys. Thank you very much. Yes.